Have you ever wondered how much the property manager actually influences the success of a deal? In this episode of the Passive Income Playbook on the Best Ever CRE show, we are joined by Tyler Krengle, who is the head of asset management at Rockfish Capital, an operator who's managed thousands of multifamily units and has worked closely with both vertically integrated and third-party management firms. Tyler brings a lot of a rare inside perspective, having been a financial analyst at Banyan Equity and part of a property management company that managed assets for major players. And today he leads operations and strategic growth for Rockfish Capital. We'll pull back the curtain on how vertical integration impacts returns and operational risk, when third-party management actually makes sense, what incentive structures LPs should watch for in management contracts, and the lessons Tyler has learned from being inside the engine room of your standard deal. If you're an LP looking to sharpen your operator evaluation skills, this episode is for you. And with that, let's dive in. All right. Hey, Tyler. Thanks for joining us today. I'm excited to have you here.
Yeah, likewise, Pascal. I'm excited to talk about some fun stuff today.
Cool. So a lot of different things that I would love to get into today. But what I'd love to do is start out with walk us through your journey of you working at a company called Banyan Equity. Kind of tell us what it is and tell us about that experience and how that's led you to today, now working as the head of asset management at Rockfish Capital.
Yeah, for sure. So, Banyan Equity Management started out as an owner operator of multifamily complexes and assets. So, that company originated basically to self manage their own deals. Funny enough that the LPs were going out and they were actually getting some pretty significant returns, and so they were diversifying into other operators and other groups and stuff, but what they were finding was they weren't getting the same returns elsewhere. And so effectively through organic demand, Banyan received requests to third party manage other deals that the LPs effectively introduced them to, which is really, really cool. Really means you're doing a great job at the end of the day, effectively. And so I started out with Banyan to effectively work in the client relations department and kind of build up the third party management side of the business, to work with GPs, to provide them advice and consulting as effectively a liaison, if you will, between the operational staff at Banyan as well as the GPs themselves, to really help them achieve their vision that they had set out in their overall business plan, and how this would serve the actual LPs as good as possible, and which obviously is going to serve the GP in the best possible way too, which is going to create that momentum of track record in particular. This led me to actually meeting a new GP coming from Germany. His name is Sven Kuhnle, and he created a pretty successful multifamily business and condo conversion business in Germany, in Belgium, Austria, and even Spain, actually, and wanted to rinse, wash, repeat the idea here in the States, specifically in Houston, Texas, to start out. And so I met him with the intent of, kind of partnering up with Banyan and everything. And long story short, after several months of, communicating with Sven on what his ideas were for this portfolio, he asked me to come in and effectively run the show and be his head of asset management operations, which is really cool because we actually just closed on our first acquisition last Wednesday. And at this point, I have hired Banyan to work as our third party manager for the asset and the rest of our portfolio as we build it. And it's just really, really cool to kind of see this come full circle for me and Banyan as well. And so getting to work with them on a daily basis to continue that relationship's been really awesome.
That's awesome. One of the things I really want to highlight in this episode is a lot of the dynamics between operators who are maybe vertically integrated versus not. And I imagine that that's a discussion that comes up at some point, maybe depending on if you're much earlier, you typically outsource. And then I imagine as you grow, you kind of insource. Do I have that right? Is that the right way to think about that?
Super, super typical. Yeah, it's you have it spot on. So I'll provide more context here. So when it comes to as an investor, right, I approach this with an investor mindset, because at the end of the day, that's really the only thing that matters. And so When you approach this as a GP who's trying to raise capital and find deals that are going to generate significant returns for investors, competitive returns, better returns than other competition in the market from other operators, you look for that edge in every single line item on the P&L. And so in this instance with management, there's really two approaches here. I go out and hire third-party management from somebody that I've got a good referral from, or I've heard good things about, or that just outright sold me on their operational capacity. Or you go the self-management route. Now, typically speaking, the self-management route is normally, especially for smaller operators, in my experience, it's one of the more common ways that people start out, because it's really the best way that a GP can learn how to service the needs of the LP, just for context. And this is really, really taught in the bulk of like syndication companies and like master classes and stuff like that, is like, oh, you can operate it, stuff like that. Issue that typically comes about in this instance is that acquisitions are a full-time job too. And so is management, especially at a smaller scale, because at a smaller scale, smaller unit count, et cetera, what happens is you've got one person that does all of these different things. They call in sick, they go on vacation, somebody, whatever happens, they're out, you're it. And so all of a sudden that takes away from acquisitions, and that takes away from, that momentum that you have to build in order to scale. And so then that leaves you to the secondary option, which is third-party management. But the incentives that take place with third-party management are really difficult to manage. So especially, with no prior relationship. And there's always a bigger fish, right? I mean, you might come in with a 100-unit property, and they might have somebody that gives them 1,200 units, across the portfolio. And so naturally, you have to spend and prioritize time, like any business has to. Where this differs for me in Rockfish Capital and Banyan is that I worked with Banyan for years. I have very strong, relationships with everybody all the way up and down the totem pole. And they're all fantastic people. I mean, truly, and they really, really care. What I love about Banyan is the fact that they have that owner operator mindset. They've operated their own deals in particular. And so it's gotten to the point where like when I worked at Banyan, we would literally sit there and say, I would go and have like a client meeting and say, look, guys, I know that you guys want to achieve X, Y, and Z, returns. In order to do that, we're going to have to reduce these line items. And so I know that you want to come in and you want to manage the construction project, but at the end of the day, we have a construction, partnership with this other company over here that's going to be able to do the same price, but they're going to be able to achieve it in 67% of the time. And this impacts your returns XYZ, capabilities. So that relationship with Banyan and the actual understanding and the inner workings of how they operate truly provides a pretty significant advantage to us, because it's the only time where those two options kind of come together and I get to, kind of benefit, and everybody mutually benefits off of it.
Help us understand, at your peak, how many units were you managing across what asset classes? What would that look like?
Yeah, at the peak, right before I left Banyan to come over to Rockfish, we were just over 3,800 units. I think it was 3,864 to be exact. Primarily B and C multifamily, couple A class, but the bulk of it was B and C class multifamily. This could be 70s, 80s, and a couple of 90s vintage. This is anywhere from 100 units to just under 500 unit properties. And so this is a wide range of assets, but it's the bulk of what trades, and it's the bulk of what makes up the overall, market as a whole.
So you just kind of talked about how you might work with an operator and talk about how you might be cutting expenses in different places to help them achieve their returns. To give the LP an understanding of when they're seeing the deal, what had to go on in the background before that deal came to them. Can you kind of touch a little bit on how, how are you able to make these recommendations to the operator? At what point are you getting involved in a deal? How have they not? Yeah. And has that happened well before the LP sees the deal, or what does that look like?
Yeah, that's a great question. To be quite honest with you, it's an exhaustive process, and it has very, very, very many iterations, and no property is the same. Every single property requires different analyses, different inspections, I mean, to the point where, we managed properties that literally were next door to one another. They were built within 3 years of each other. They were built by the same person, but the rents were completely different. The amenities that were desired by the tenant base, entirely different. The tenant demographics were entirely different. I mean, one was favored for student housing near a college, and they were both, again, they shared a fence. They literally shared a fence. And the other one was, more so workforce housing. And so it really is a human element to this, which is honestly for an LP to decipher like who they're going to invest with. That person, that gut feeling, that human element judgment that takes place. It's not just a spreadsheet at the end of the day. There's a lot of spreadsheets, but having that person that can really go and make a good judgment call on the asset from a first impression look is really the most important first step. And then after you go through that, like, yeah, this looks like a good deal. Financials look pretty clean for the most part. Nothing crazy sticking out to me. Yeah, there's a couple of modifications here and there. We'll run, a couple of numbers, and you run like an initial underwriting. At least this is what we do in particular. Like we'll run an initial underwriting and say, this is worth checking out. These returns initially suggest that it's worth, at least going to tour the property and getting some more info. Next step at that point is then going and touring the property itself, getting an idea of what the story is. How long have the sellers had it? Why do they want to get rid of it? What's going wrong? What's going right? Et cetera, et cetera. Then getting some more clarity on different, items on the T12 or the profit and loss statement that you can actually take back to your underwriting. And then if you deem that tour is worthwhile and that the CapEx is not just like grossly over leveraged on the actual deferred maintenance side, there's only so much money you can get out of new roofs and gutters and stuff like that, but they're all necessary, of course. So after you go through that initial screening, that's when you decide, okay, let's go put some pen to paper rather than just pencil. We'll go get some hard quotes, property tax consultations, some insurance premiums, stuff like that. We can kind of get a really good idea. Then we involve property management. At that point, we go to property management. This is really, really important. This is actually so important. It's frustrating to me that this is not more common practice, to be quite honest with you. There are two different types of GPs I've learned. There is the GP that says, I love this deal. I'm going to buy this deal. We need to get this deal so we can get some momentum and get some, better deals on our portfolio. And so they underwrite the deal by themselves of what they expect it to be. And then they move forward, they put in an offer, and then they get under contract, and then they involve management. This is a fatal error every single time because no operator or GP has ever got, to my experience personally, has gone in under contract and actually set expectations that are within reason for the specific management company that they're hiring. Even if it's a self-management deal, they're more likely to have a smaller margin of error if they're self-management. But then again, they're putting all the chips on themselves. So when it comes to this part of the process, in my opinion, it is very, very necessary to actually involve management prior to submitting an LOI, a letter of intent to offer, and making sure this is where I've got rents at. This is what we think we can take them to. This is how much we expect each of the units to cost for these specific renovations. This is the information I have. Do you think you can achieve this business plan? A few tweaks here and there, a few edits, et cetera, et cetera. If the end all answer is yes, and the returns shake out to be roughly the same, or if not better or slightly worse, if they're still okay, just something that we can pitch to an LP and they'll say, yeah, that's a good enough return for me to invest in. That's when we submit an LOI. So this is all up until we put the offer in, and there is that much due diligence taking place just to get the offer in. And that's unfortunately only 10% of the battle. So the rest of it is far, far, far more intense after that, especially the due diligence period.
Yeah. So I guess one thing I've never really thought of this, but how, there's always been like you can have a third party property manager or in-house, but I never thought about is that property management company, the third party property management company that the GP is working with, like how do you evaluate that relationship? How do you are they a sounding board or not? I would imagine, yeah, I mean, I hadn't thought of it, but having as many people that you can bounce your quote unquote business plan to and them, i.e., the third party property manager, shaking their head, yes, thumbs up, would be a way to like just double check if you're even in the right direction. That's kind of, I guess, like from your experience, how often is that happening?
Not often. I would say, in my experience, 75% of the time, there is zero consultation with management prior to the actual offer and or contract being in place. 25% of the time, it's a, hey, this is what I've underwritten. Do I have this right? But the 75% of the time, it's, hey, this is what we underwrote. Can you make this happen? And if the answer is no, there's no business. And that's, in my opinion, a very wrong way of going about it. Because if you go to 5 different management companies, you're stuck with the one that says yes. And what do you think is driving them to say yes?
They want
It's
your
not
business, of course.
necessarily, yeah, to earn the business. It's not necessarily like, yeah, of course we can do that. It's the same thing with, I'm not saying that this is like how the world works or anything like that, but like it's in some cases, like you go to like, this could be insurance brokers, this could be mortgage brokers, this could be investment sales brokers. I mean, actual property brokers. And you go to them and say, I want to sell this deal for X amount. I want to get insurance premiums at this amount, or I need agency lending at this interest rate. Can you do that? You ask those questions to those respective parties, and a couple of them will tell you no, but a lot of them are going to tell you yes. Does that necessarily happen all the time? No. And in fact, it happens probably less depending on the expectations of the actual, client. But similarly, that's why I believe you need to check with them prior to the offer or contract being in place rather than after the fact, because otherwise you can't guarantee that the due diligence you're doing is actually selecting the right party to help you achieve the returns that your LPs need. If you do it prior, then you can make sure that honesty, ownership, and accountability exist.
So one thing I'm always trying to think through is, as I listen to these podcasts, how can I take some nugget from this conversation and implement it into my investing system? And I'm imagining this is a one-time trust but verify conversation that you have with the property management company of a sponsor that you're potentially working with. Like, hey, you see a deal, you talk to the operator, you like everything about it. And one thing you say is, would you be willing to share the contact information of the third party property management company you are retaining for this? And then you would ask that property manager directly, like, at what point did they get involved? And that would be an easy way to check. Is there, do I have that right? Is there any other way? I mean, I would imagine the property manager is a third party, still retained by the operator, and so maybe is incentivized, give the LP a good impression. But I imagine there's a way you can ask that to pull this out, and you would only need to do it once with an operator to understand how they operate.
Yeah. Yeah. I mean, it's not a bad idea. I can tell you, in all of my years of property management experience across all asset classes, I've never once had an investor call me ever and say, do you really think you can achieve this? I'm kind of glad, to be quite honest with you, because a couple of times I would have had to, I probably would have lost a client or two. But at the same time, like, it's not a bad idea necessarily, but it's not also a very customary practice to call a property management company and do that. Now, with this
I
being
mean, maybe
said,
not for the retail, but I would
yeah,
imagine if you're a family office or you're a large institution, you
100%.
bet your ass they're calling. I imagine, yeah.
Yeah. So that was the next point I was going to make. Now, with this being said, I didn't have like one single like retail LP investor call me necessarily. I have talked to dozens of institutions and explain to them, the reasoning as to how we operate, what this looks like when I was on the property management side, and why it differs. Yeah, 100%. But you make a good point too, Pascal. Like, you think about it, like, if the institutions are doing it and they're the ones that are generating all these returns and this critical mass of the portfolio itself, then it's really not a bad idea for the retail investor to do, if not a great idea, actually.
I think if there's one thing I am really putting my foot down on and have a point of view on is that, the reason GPs like to raise money from retail is because it's easier and you don't have to convince them as much, and they have less control. And um, than an institution that asks for control rights and makes sure they get a specific earn out before the operator does. And so I think about it as, what do the institutions, or what does a pro look like? And then let me work backwards from that. And, I think, yeah, easy for an institution to do all these things when they have a lot of resources. But you also can pick and choose what are the things that these big guys do, because their business is to make money.
Yeah.
Yeah.
I mean, there's validity to what you're saying, but from the capital raise side, raising capital is hard, no matter what. It is really, really hard. And it's funny that, you kind of mentioned like the retail investor might be easier than the institution. Like I would actually, I hear what you're saying on the operational side of things, but to be quite frank, I would actually argue that it's more difficult, first of all, to raise money from the retail investors, easier to gain access to the retail investor than it is to an institution. Finding an institution that'll actually listen to you, very, very challenging. Once you're in the room, it's a lot easier. It's like a way easier, to be quite honest with you. We found, and with every GP I've ever worked with, with Rockfish in particular, on the management side, the institutions asked far less questions than the retail investor. Far less questions. Getting a $20,000 check versus a $200,000 check, the $20,000 check is so much harder to get than the 200,000 every single time. No questions asked. It's never the other way around. Not in my experience.
I would imagine there's still the I can buy some. I can buy a lot of that. That I definitely know. A $5,000 investor versus a $500,000 investor,
Yep.
totally different.
Yeah.
And you're going to hear a lot about that in another episode I'm going to film here with people that were on the tech platforms that raise money. But I think with retail, they are asking more questions, but I would imagine the institutions do a lot more verification. Like, because I mean, at least all the institutions I know, they're all focused on, how do I reduce risk? And you reduce risk by getting additional inspections, checking the report, verifying all the documents. I mean, I know institutions that will take like the trailing 12 months that someone gives them and then asks for all the bank statements, and they literally recreate the entire last 12 months in QuickBooks and validate if they are the same. Yeah. So is, from your experience, do you not feel that way?
Honestly, I have not had that same experience. Like, we send a pitch deck to an institution. I'll give you an example. I can't name names or anything like that, but there's this large firm, very large firm,
Billions.
and they one of their C-suite executives was on the investor call list. Didn't even an attorney, okay, practiced in law, and didn't even worry about the pitch deck. Checked out the underwriting package, checked out the SA, the OA, all of that stuff, the PPM. But other than that, seemed like a legit group. Works for me, and it was a sizable check. It was a sizable check. On the contrary, going down toward, closer to like the minimum investment, we were having people saying, well, can we give you half of the minimum, and then I'll give you the other half for the next deal. And it's like, well, that completely takes away from the minimum. And so, like, the point that I'm making is like the the actual process of communicating is far more streamlined, because, like, for example, as a GP, you go in, I know exactly what I'm looking for these properties. I mean, I've done dozens of takeovers for multiple GPs. What's cool about that is that I learned what everybody looks for. And so I know what matters most to me, or what mattered most in those scenarios. And so what now matters most to me. And so I go in, and I mean, there's a lot, for example, like 70s and 80s vintage multifamily. Not many people know that stab block breakers, Federal Pacific breakers are a problem. And so they go into the deal thinking that they're all good to go. And then all of a sudden, your insurance carrier finds out that you've got some out of code breakers. And so now you find out that it costs $2,200 per unit to replace all of them. And if you don't replace them, your insurance premiums are going to double. And so you've got to take care of it now. And so like there's these different things like questions that you go and look for. And I know what I'm looking for based off of the different property. A lot of these more experienced, sophisticated investors that write the bigger checks, they also know. Like I had one, for example, that said, hey, this looks like a 80s vintage. Doesn't seem like, you're going to be worried about asbestos, I imagine. And I was like, nope, not worried about it. We did check for it, but all good. And he goes, perfect. I was just wondering because, it was a little, wonky on when the actual code went into place to ban it. But other than that, it looks like the rest of your CapEx is pretty comprehensive in your pitch deck and your overall underwriting package. They know because they've been in those shoes before that I've covered the important bullet points. The LPs that write the smaller checks are typically, this isn't always the case, but typically are newer into investing. And so they ask more questions because they don't know what they don't know. And there's nothing wrong with that. I ask dozens of questions because, again, I don't know what I don't know. But through the process of forming that relationship with the operator, going back to your point of trust but verify, it's typically I ask the question once and know based off of their answer if I can trust if they've got it taken care of going forward. There's nothing wrong with asking the questions. It's typically building that relationship up front, but finding those answers to those questions, it's first you have to know what questions to ask. And typically we find that with the newer investor that's closer to the minimum investment amount, they typically have more questions because in the process of going through that investigation and asking questions that, you're finding or researching that are important, you're also finding follow-up questions that pop up into your head along the way. And you're thinking, this is important too. And so, in my opinion, it is up to the GP to be an educator. It's really, really important that that education sets in from the GP's perspective. Because first of all, if you're asking somebody to invest money with you blindly, you should not be in this business. Period. I mean, that's just an unreasonable ask. On the other side, you're trying to paint yourself as an expert here and establish trust with an LP investor. And so you should be an expert in these topics. And so the way that I approach this in particular is like, what other questions do you have? These are great questions. What other questions do you have? And I keep asking that question over and over until they say, well, I'm out of questions. And then I turn around and say, well, here's what you didn't ask. So let me tell you what questions I would have asked in addition to what you've already asked. I think that is really, really important from a GP's perspective because you wouldn't want somebody to invest with you. I'll give you a perfect example, actually. I had somebody that was wanting to invest with us and they were asking, I want to invest with you. I love the cash on cash returns. I'm seeking, good distributions that, makes my money worthwhile. And they asked a bunch of different questions. This was a first for them. They were in the shipping business. And so they were used to a more liquid asset because you can lease shipping equipment and then you can turn around and sell the contract for the value. Super, super easy. It's very quick. Real estate's not the same. If the lease value of like a shipping equipment, for example, is the lease value, I mean, it's really simple. There's a number behind it. Cap rates change all the time when it comes to real estate. So that doesn't, your lease value has a part of, the valuation, of course, but the market value and it really influences the cap rate. And so long story short, this investor did not ask the question about liquidity. And knowing his background in a fairly liquid asset class and industry, he said, this is the question you're not asking. How long is my money locked up for? And our hold period's 5 years. He goes, 5 years? He goes, I thought I was going to get all my money back in 2. And I was like, well, you're going to get half of it back based off of the current cash on cash return estimate. But you're not going to get your principal balance back until later. He's like, well, can I just withdraw it? And I was like, no, you cannot. That's not how this works. So I think that's a big part about being a GP is making sure that you're educating on all questions that they're asking, but also not asking too.
Can you tell me a little bit about how management contracts are structured, and if that's something that can like influence, the relation, how that influences the GP and property manager relationship?
Yeah, that's a fantastic question. There is a standard agreement amongst management companies, especially in multifamily, and the GP, and it is typically a percentage of total income. Standard is roughly 3%. So 3% is the rough standard. And then depending on the management company, most of them will have a minimum in place. And this is really important to understand because not most management companies will put a minimum in place of where they think their baseline standard is. And this is really like a catch-22, to be quite honest with you, because there are some management companies that will throw a super low minimum in place. And that actually is a red flag to me.
Minimum in what way? Like we need to pay the property manager at least $300,000 this year, or like the greater of 300K, or 3%
Got
of
it.
all income.
Yeah, the latter. So like, let's just say your total income is 100 grand every month and they got a 3% fee. You're paying them 3 grand every month. But what if their minimum is 2,500? Well, that's fine. That's a good buffer, right? Because if they dip, you don't get penalized for it. Well, I mean, you do, obviously, but you don't get penalized further through their minimum. Now, if they have a $1,500 minimum, it's like, okay, well, hold on. At $1,500, it's not worth it to you to manage the property of this size. And so it becomes a perpetuating downward spiral because all of a sudden, back to that point that I made at the very beginning of this podcast, was really the actual incentive has to be aligned as well. They have to prioritize their time, going back to that 100 unit client to the 1,200 unit client. And so if they're making 15 absolute mess, then they may not be prioritized. And the reason that they do this, by the way, is because in some scenarios, you've got distressed assets that are distressed for reasons beyond the manager's control. This could be poor financing. This could be exceptionally high aged payables for reasons that happened prior to your arrival and taking over of the asset class. There's only so much. The way that I put it is the management company can control everything above the line, above net operating income. If it's an operating expense and it's operating income, that's what they can control. When it comes to below that line, they can't really do anything. So in that instance, a low minimum can be a disalignment in incentives between the GP and the actual management company. On the flip side, you've got an average $3,000 management fee that your pro forma underwriting is telling you they're going to be at from your total income. And even on a stabilized asset, post all of your renovations, rent increases, et cetera, over your 12-month stabilization period, you're going to be generating 150,000. And so maybe they're at a $3,500 management fee every single month. Well, in this instance, if they're putting the minimum at 3,750 and you know that you're not going to get there for 3 years, that's the other side of the aisle that you have to watch out for too.
So, wow. So I'm just trying to think of, like, as an LP, like, does this matter? I mean, is this standard practice? And, this is, I mean, interesting to think about, but like maybe it's more relevant if you're doing a development or if you're in a turnaround project than like maybe a standard value add, or like, is this something that you can ask about, or is this, just, yeah. Tell me.
I don't know if there's any question that is really off limits for an LP. And if I was told that as an LP, I would have made a quick decision right then and there. If I'm an LP, I put my LP hat on, right? And I walk up to a
Yeah.
GP and I say, hey, this is a distressed asset. You've got 40% down units, or vacant. I know that you want to come in, renovate everything, and then lease it up. You're not going to make cash flow for the first 6 months. How is the management company incentivized? What's that contract look like? What's their fee structure? What's their minimum? What's the actual, percentage that they're taking off of your income? And if I was told, well, that's really none of your business, well, I'm going to go invest with a different operator. I mean, it's really that simple.
Yeah. I mean, and in that case, they would just give you an answer. And then, it's like, as an LP, what do you do with that information? What should I be looking for?
Yeah. Yeah. I mean, I would compare it to the overall pro forma. So like for us in our underwriting, we've got the next 10 years worth of expected T12 expenses and incomes for each and every line item. And so including the management fee. So for me, I'm looking at the overall minimum and the percentage that the management fee is projecting in their contract. And then I'm going to go compare it to what the pro forma says. If the pro forma, like for us, we base it off of a 3% management fee. So I come in and I know months 1 through 15, the stabilization period that we're expecting, they're going to be making anywhere from $5,100 a month to $5,950 a month, all the way up until the 15-month stabilization. If they put a minimum of $6,000 in place, I'm going to question that because according to this pro forma, you're not you're not accommodating, or you're not, what's the word? You're not actually placing that cost into your pro forma, that delta between the minimum and what their fee comes out to, until month 18, which means that you're paying a premium for 18 months before they actually balance out their actual value based off of the percentage you signed up for. As an LP, that's what I'm looking for. Contract says $6,000 minimum. Performa says you're stabilized at 15 months, but you're not actually getting to a point where that 3% matches until month 18 or whatever it is. So your net negative cash flow, or your net cash flow, is wrong at the bottom, because you still have to accommodate another $900 a month on average for the next 18 months.
So, percentage of revenue uh, and prioritization there feels like a mismatch between the GPs and the managers. Because if you as a property management company who has 100 clients, and one of your clients, their portfolio isn't doing well, you only miss out on like the 3% of the revenue, which is pretty small, I think, to begin with. I imagine you don't, from a bandwidth perspective, like you mentioned, the person with 1,200 units versus the 100 units, the others get prioritized. So that, to me, I dealt with this problem firsthand in my own real estate portfolio. I've had a third party management, and now I've brought all my management in house, and it's a day and night difference. Talk to us about why is it structured that way? I guess I feel like as an LP, I would almost never want to invest with someone if they didn't have it vertically integrated. So can you help like make that case and maybe talk to both sides of that argument?
Yeah, 100%, 100%. Someone's making the paycheck, no matter what. Could be self-managed, could be third-party managed. Someone's making the paycheck. In my opinion, I know I can manage a property management company. I've been doing it for a long time, actually, now. Um, I have no issues bringing it in-house. I also know that I'm a trustworthy person. I'm accountable, and I know that I'm going to do what it absolutely takes to maximize economies of scale benefits to the property, portfolio, and LP. I know that for a fact. And along the way, my incentives as a GP are aligned with that of the LP. That's a fact. That is just how this business works. With management, you mentioned something about the fee being tied to the revenue. And it's really, really important that we clarify what this is actually based off of, because it's not gross revenue. It's off of your total income. And total income is your gross potential rent minus your loss to lease, minus your concessions, minus your bad debt write-off, et cetera, et cetera. And so that number at the bottom, oh, and plus other income. So that number at the bottom means that they don't get to just say, well, market rents across 192 units total out to 250 grand. 3% off of 250 grand. We're looking great. It's not that. Loss to lease, our market rents are $1,500, but y'all are only capturing 1,400. So it's not based off of that 1,500 times however many units. It's based off of that actual, after the loss to lease, after the concessions. If you can't lease effectively with the current market rents, then you have to put concessions in place, which means that your training on your lease, there's a lot of impacts here. If your leasing training is not up to par, if your marketing efficacy doesn't take place across your marketing budget, all of these things contribute to the total income line. If you're not generating enough reserved parking income, maybe your pet fees are really low. What's going on that's taking place? Why is our total income not increasing, even though our gross potential rents are? That is what a management fee is based off of, is that total income. Now, to your point, not all management fees are necessarily based off of that. So that's another thing that I would look for as an LP as well, is based off what line item is this fee based off of? And it should be based off of total income, which on most TEATs is post concessions, loss to lease, bad debt write-off. This incentivizes the management team to make sure the collections are excellent. It incentivizes them to make sure that economic vacancy is as low as possible. But it also incentivizes them to grow the actual rent increases, which means lots of renewals with good rent increases, and how can I upsell them on different aspects of what the property provides. That's the case for third-party management and their alignment of incentives. Now I'm going to take a very slight detour here and talk about a story with what other services management can provide. Construction CapEx. This is a huge project that requires an enormous amount of oversight and organization. Having roughly 15 different contractors show up to your property to get it to that end-all vision that you planned at your underwriting before you even submitted that LOI takes an insane amount of hours. I mean, especially based on scale. And so it's really important that middlemen are removed from the process, because that leads to context switching. And in my opinion, context switching is the number one productivity killer out there. So making sure that the property manager, the regional manager, and the actual management company are aligned with your goal of what you're trying to achieve on the CapEx is really important, because they're the ones that the contractors are going to pop into the office, say, hey, I need into these units to go get the panels replaced. I need to go get on these buildings to replace the roofs, whatever. So there's another service that's added to this management agreement that we're talking about. It's the construction management agreement. This is probably where the largest areas of misalignment exist, in my opinion, because now this is based off of the construction cost. What's one thing we all know about construction is that it definitely never goes as planned, ever. Does not matter how accurate you get. You could have that in-house if you wanted to. It's still not going to. So I've created this new contract that seems pretty simple, in my opinion, on how we operate with our construction supervision agreement. And this involves an alignment, a realignment of incentives. And this really impacts the LP. This is another question, if I'm LP, is how are you carrying out these CapEx projects? Who's doing them? Who's managing them? How much does they cost? What happens if it costs more? What do you do if it costs less? What are you doing with the remainder, et cetera, et cetera? So this construction management fee is typically anywhere between 5 and 10% of the project. You got $1 million project, 5%, they're paying 50 grand. If it's 10%, you're paying 100 grand. Pretty simple. What happens if your $1 million project at a 10% management fee ends up being a 1.2? Not only are you 200 grand over budget, but you're now paying 120 grand to the management company. So you're actually 220 grand over budget. And so you're creating this perpetuating issue. And so the way that we've gone about this is that we have placed conservative underwriting into that of the contract structures and the agreements. So we did a contingency. So in our CapEx budget, we always place a contingency. We do about a 5% contingency. So about $1 million on, well, and it's per project. So for the interiors, if the interiors are 500 grand, then we put the 5% contingency, and then the same thing for the exteriors. We then base the management company's fee off of the post contingency price. Then we create a reverse dynamic adjustment on the actual fee. So let's just say $1 million project, post 5% contingency, and it comes out to being 900 grand. Well, we changed the management company's fee from 10% to 11%. So it goes up by the percentage they come in under budget. Now, on the flip side, we remove any increase to the fee as a result of going over budget. So if you end up going from the $1 million budget to 1.1 million, their fee is the same as what it was intended to be post contingency at the million. And so they are diminishing that of their own percentage as a result of going over budget. So I know there's a quick sidebar, but like, in my opinion, that is the biggest opportunity for misalignment with an overall like construction supervision contract and with the actual management company. That realigns incentives. So it's a really good example of how you can realign vendor contracts. Now, for the other side of your question of what can we do to basically speak against why third-party management is necessary or why self-management is
why not
greater?
vertically integrate?
Why not? In this instance, I think it goes back to my initial point.
Actually, let me reframe that. It's like, as an LP, why should I invest in anything that's not... So why should I invest in anything that's not vertically integrated versus just integrated?
Yeah. So I think the main answer to that question truthfully comes down to what's the goal of the GP? What is their scale at? And what is their intended scale to become? For us, we have a very unique position because I know everybody's first name, last name at Banyan, birthdays, anniversaries, you name it. And it's different. But if you go to like a normal relationship, that third party management relationship may not be the same. And therefore, the communication may not be the same. It may be very, very different for somebody to invest in third party management because it could just be another client that they're just seeking volume. There are a lot of management companies out there that seek volume, specifically ones that are acquiring other management companies are seeking volume. They're not seeking organic demand and growth. This is really important. This is a reason why I would not go with a third-party management company, and I would rather go with a vertically integrated company. I would rather go with somebody that is incentivized to grow a portfolio, because what is required to grow a portfolio is proof of concept. What is required to achieve proof of concept is exceptional performance and returns. So you know that. What leads to all of that, obviously? Vertical integration is a perfect ecosystem for incentives as far as that's concerned. Management companies that are going out and acquiring other management companies are growing because they're acquiring other businesses. That's not necessarily a bad thing, right? But that means that focus is being taken away from what truly matters, which is growing through organic demand, which means scaling. And scaling means proof of concept. Proof of concept means exceptional returns, et cetera, et cetera. So again, going back to that context, switching is a killer of productivity. And so if they remove the focus from actual organic demand and portfolio performance, you're misaligned right then and there. Vertically integrated is not misaligned in that instance. The caution with vertical integration is that it is, again, a full-time job to do acquisitions as well as a full-time job to do management. So with this being said, once you achieve a certain scale or invest ahead of time in the staff of that scale, you can achieve both full-time jobs, obviously, to do so. It's the very reason, going back to Banyan, for example, how their organic demand took place was they were focusing so hard. If you talk to the owner of Banyan, she'll say the exact same thing. The LPs were going and investing in other deals and finding, oh my God, these returns are nowhere near what I was getting over at Banyan. Maybe Banyan will consider third-party management. And then that led to one thing, led to another, et cetera, et cetera. But again, they were focusing so hard on the operations that the LPs were looking for other acquisitions because their returns were justifying expansion now. But Banyan was like, I need to focus on these operations to make sure that we maintain this excellent performance. So it's a catch-22 with vertical integration as well as third-party management. There are pros and cons to both, but they're not all the same, and it's not a blanket black and white either.
Is there a specific, if you're an investor type, I personally like to invest with larger institutions, people that have been around for a long time. There are people that really like working with emerging managers because they can get better terms. And so is there a type of LP that, you recommend or you imagine works better with an operator that's vertically integrated versus not?
Man, that's a really interesting question, to ponder, because I know firms that are quite literally worth between 2 and 7 billion that are invested with more boutique, self-managed investment firms, family investment firms. And I have heard each of them state this investment consistently generates the highest returns per investment basis in my portfolio. I've also heard them say that this is killing my overall average. But with that being said, the institutions, massive institutions, are generating significant returns and therefore continue to invest with these more boutique style, vertically integrated owner operators. The issue that the institutions have is that they have so much capital that they have to deploy. There's not enough for them to dump into these smaller vertically integrated owner operators. Almost never is there enough space for them to dump the capital they actually need to deploy to do so. Luckily, they have access to far greater number and volume of investment opportunities. But I would say a lot of these other investment vertically integrated owner operators have a lot of investors that come from like-minded industries. And, you think about these other like syndication groups, these masterminds and these other groups that, they're teaching them how to self-manage these multifamily deals, build a portfolio, raise capital, etc. They're teaching you, yes, but the biggest value that exists within those groups is the connections with other people that are looking to deploy capital. And so when it comes to like the retail investor, I wouldn't say the retail versus the institution investor is better for any one vertically integrated owner operator. I say they both serve a purpose. Sorry, the vertically integrated owner operator serves a purpose for both investors. I think that most GPs start off as an LP, and so they probably benefit the most.
I imagine you have a really great insight into who really great operators or GPs are. Can you talk a little bit to maybe traits of great operators and maybe bad habits of poor ones?
Yeah, that is there's a lot of color to that answer. I think it really comes down to, it doesn't truly even come down to a ton of experience. I think it comes down to vision. It comes down to organization, and it comes down to, truthfully, emotional IQ. I exist behind spreadsheets all day, every day. I feel like I'm really good at financial analysis at the end of the day. But the thing that makes me effective in asset management is being able to decipher who's a good person to work with. And I think that makes, Rockfish an excellent GP for that reason, because all three of the people that, like between Sven, me, and then our head of acquisitions, Alex, we all have a really good grip on reading people. Are they honest? Are they informed? Are they ignorant? Are they negligent? Those are 4 things that we really look for when we look to work with anyone. And unfortunately, you can't get that off of a first impression. I think that that's important too, because what do they say? Like most first impressions are made within the first like 7 seconds or something like that. You have to ignore that 7-second impression. Otherwise, you don't get to the nitty gritty of things. Like, don't get me wrong. Don't forget it, but ignore it until the full assessment is made. One of my favorite lines from most brokers is, man, I would invest in this deal. It's like, really? How big of a check would you write me if I put in an offer today? 99% of the time, the response to that question is, well, it depends on how big your offer is. And what does that tell you? At the end of the day, it's not something I would invest in today. It just depends on what my check ends up being, from you, kind of thing. And so that doesn't hardly come to fruition. The GPs are really the same way. What is the goal? And if the goal is myopic in the viewpoint of, I want to close this deal and generate good returns for the investors, it's just kind of bland. Like, that's everybody's goal, right? I mean, that's an obvious goal. How do you plan on achieving that? Well, we're going to achieve that by implementing intrinsic value throughout the property and generate value through NOI while mitigating risk at the same time, blah, 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 blah. It's just like, this is such a bland, like, yeah, like good script. Like, I'm pretty sure you can download that, off of, we won't name names, but other, groups out there, masterminds, stuff like that. But what is the real goal? Like, is the real goal, like, for example, like, we have a goal. Like, everything that I do in asset management has to, like, anything that we implement value add has to serve 3 purposes. It has to improve the lives of the tenant community. Number 1 has to happen, because they are your customer at the end of the day. You have to improve the tenant community. And are they proud of where they live? Or do they feel safe? Does it feel like home? Because that's what you're doing at the end of the day. You're creating a home, regardless of how temporary it may be. The second thing is your staff happy? Is what you're implementing going to improve their life in the form of purpose or finances or streamline their overall workflow? Half of a job is purpose, the other half is pay. Are you fulfilling both of those needs? And then the third thing, of course, is, are you generating value in the form of returns for the investor? It has to check all 3 boxes. If it does not check all 3 boxes, we are doing something wrong. And that's the goal, right? At the end of the day, that is genuinely the goal, is, are we improving the lives of everyone involved in this process? Because if we are doing that, the money will come, the returns will come. All of that will come after the fact. Everybody forgets what property management is at the end of the day. And like, yeah, it's, we're trying to, like, nice fresh coat of paint, make sure that the gutters are in place so it doesn't degrade the foundation below the buildings. We get that. Like, okay, we
Yeah,
understand.
but how do you determine if a GP, like what a good GP is? Like I'm an LP. I'm talking to a bunch of different GPs, and I'm trying to understand, who's good to work with and who's not, and like from what are all the angles I can ask questions from. So from your experience of working with a ton of different GPs, what is that separates them versus not? Are you saying that like they're if they're just in it to like turn a profit and they're like in the spreadsheets, like avoid those? So, like those are typically the worst ones, or like tell me about how you like the trends you see across other GPs from your experience sitting in your seat.
Yeah, no, I'm not saying that there's obviously greed exists in every industry. I feel like you're hinting towards that. I'm not saying that, that's the case or anything, but I'm really adamant about that emotional intelligence has to exist. And the point that I'm making is to be a good operator, you have to really understand how it all influences one another. And so the question for me, if I'm an LP, is what is your goal? Is your goal to generate super high returns? Okay, fair enough. They may not have the answer up front. How do you plan on doing that? And in my opinion, they have to understand that they are creating a home for people. And how are they going to do that? And that's the point that I'm making, because everything comes after that. I mean, everything that you want comes after that, but they have to understand the premise of what's required to do that. And it doesn't necessarily make sense. Like, you could put new flooring in every single unit. You could put granite countertops. Oh my God, this drives me nuts. People will put granite countertops and say like, oh yeah, I just put granite countertops in. Like, boom, all of a sudden it's worth, another million. Bam. No, it's not, because your tenant does not care about granite countertops. They don't care. They care about affordable rent that you cannot provide them the moment you put those granite countertops in, because you need to make the money back on them that you spent on them. And all of a sudden, what have you done? In the pursuit of returns, you've forgotten that you're creating a home for somebody. And now you can't get those returns because all of a sudden that home doesn't exist for anybody, especially the tenant demographic that you're marketing towards. And so how you ask this question is really up to you at the end of the day. But in my opinion, I'm going to a GP, I'm looking to invest. I know you want to generate 15% returns. How do you plan on doing that? I don't care about the flooring, if it's vinyl, porcelain, tile, I don't care. I want to know what your intent behind operating this property means. Why are you doing this? Like, what is the impact you intend on making, and how does that relate?
Well, I think if I think about all the deals I look at, I mean it's pretty standard that they're like, we're gonna take this asset, we're gonna repaint the outside, maybe fix a roof, we're gonna upgrade the counters and the cabinets, and like, there's a lot of room because it's been outdated, and so we're making it a nice home. I mean, I think I could argue that, and I think that's like the generic thing I see across all value add deals. So
Yeah, but
how
it's
would I?
not curated though, right? I mean, like, I get what you're saying. On what we literally just acquired on Wednesday, I am putting a fresh coat of paint. I am redoing the floors. I'm putting new cabinet fronts and new countertops and new appliances in every unit and new light fixtures. It's all standard, right? But the seller was putting stainless steel appliances in there. And what we found was no one cared about the stainless steel appliances. In fact, the tenant demographic was primarily families, and their kids they play in the kitchen, ding up the stainless steel. Stainless steel appliances show dings on them far more than the black appliances do. So what we found was the tenant demographic didn't care about the stainless steel. So what does that mean? It doesn't matter to them. They're not willing to pay more for them, and you have to charge more when you buy them. So
So
it
as an
has to be
LP,
curated.
I'm looking at a deal, and how do I tell? How do I know that?
Yeah, I mean, that's kind of the end all question, isn't it? I mean, for us, I feel like, for not even for us, for other GPs that I've worked with, right? Other instances, there was this very specific GP that I used to work with, and they had a pretty old vintage. It was a 1970s vintage property. And I asked them like, hey, like, why are you putting these upgrades in place? We had taken over the property on the management side well after they had bought it. And I was like, why are you putting these upgrades in place? And they're like, this is the business plan. And I was like, okay, why are you putting granite countertops in here? You're putting porcelain laminate style like tile throughout the entire unit. You've put stainless steel appliances. They've got chandeliers in the foyer. This is like a 72 project. Like, they're huge units too, by the way. Putting brand new argon windows in, all kinds of stuff. The property lives on a chiller system. I don't know if you are familiar with chiller systems. You ever heard of a swamp fan? Put a fan with an ice cold bag of water on the back of it. That's your AC. That's effectively what a chiller system is. If it was me and I know the tenant base is going in there and they're willing to pay $1,300 a month, which is what every other property is doing. I can't afford the $1,800 a month for the chandelier and the quartz countertops and the porcelain tile and the argon windows. It doesn't make sense. What I would love is to have a mini split though, and not a chiller system, because a chiller system is either on or it's off, which means the whole property either has cooled air or hot air. You don't get to choose. Unit 101 feels cold in the spring. They don't get to turn the heater on unless the chiller's off. So the point that I'm making is, in this instance, I asked the GP, why are you putting these upgrades in place and not really taking care of the problem that the residents wanted? And you could see from the seller's reviews that everybody complained about this chiller system. Everybody did. Don't get me wrong, it's an expensive CapEx project. I get it. But so was what you're doing in the units. He goes, well, I lived here for 3 months and, I think I'm actually going to stay for the next, year. And this is exactly what I wanted in my unit. Going back to my point, it has nothing to do with the tenant community at all.
Something I picked up there is matching what are, if there are negative reviews for a property on Google for a building that's being bought, are those problems being fixed? Would be a good one.
That's 100% right.
Tyler, this was an incredibly fun conversation. Thank you so much for sharing your point of view from being within the property management world and working with a ton of different general partners. Where can people go learn more about you and what you do?
Yeah, I mean, I feel like I've a little bit of everywhere nowadays, but we have Rockfish Capital. You can check out our website, see my LinkedIn, obviously, and just look up Tyler Krengle. You can see some of the other projects that I'm working on with our management company, Pacific Properties Management. We have our own customizable short-term rental fund that's completely separate from Rockfish, and it's really a vertical integration for our management company on the short-term rentals, Pacific Capital Holdings. And so, in any of those categories or any of those websites or connection links, I think my calendar is attached to all of them. So yeah, you can reach me in any way.
Love it. Thank you so much. And for those of you that are just looking for access to all different kinds of cash flowing deals, you probably know about my investing database where I have over 700 different deals. And so if deal flow is an issue for you, I encourage you to go to passiveinvestingstarterkit.com and that should solve your deal flow issues. Wrapping up here on the Passive Income Playbook, part of the Best Ever CRE show. We drop episodes every Thursday, so be sure to tune in each week. And if you enjoyed today's episode, subscribe, leave us a review, reach out to us on LinkedIn, tell us, send us an email, tell us that you liked it. It's always helpful to understand what's resonating and what's not. So thanks for tuning in, and we will see you next week for another episode of the Passive Income Playbook.